Again, lovely day and lovely weather wherever you may be. Exciting times for us as we continue, giving insights on very pertinent issues in as far as our business finance is concerned. For the past two podcasts, we focused on borrowing. Specifically, in the first episode, we talked about loans as a form of borrowing. There are several other forms that businesses, access as forms of borrowing or financing their activities. And then last week, we zoned in on why businesses consider certain borrowing as bad, certain borrowing as good, and why it's difficult for businesses to actually appreciate that they need to understand the aspect of borrowing before they actually make that decision. Today, we get deeper into the conversation and we speak about the aspect of risk. And risk is a big issue. As usual, I'm joined by my expert analyst, Chrispin Daka. CD, always good to have you on this podcast.
Exciting, exciting. I was so looking forward to this. Exciting moments. Yeah. So no, so glad to link up again and share our thoughts and experiences on this very important topic. Because for me, there is no success in business without leveraging debt, because otherwise it's never gonna happen. So opportunities will not be executed without just with our own money. It's we can't scale. So we need the loans, but we need to know what to do. And here we're here to share experiences so that it can have the impact that that it is designed to give.
Excellent. You keep talking about one thing that I'm beginning to, like, don't borrow for consumption, borrow to reinvest into the business. And I think that is a very good, line that you keep emphasizing on you asking businesses not to borrow to consume the money, but try and reinvest. And you also talked about the difference. It's pretty obvious for you and me what is the difference between margins and profitability. And I remember very well a long time ago where we grew up, people that we grew up around were, linking revenues to profitability. But here we are now. You are saying margins are not the same as a profitability. Just a recap on those few aspects that I've highlighted before we get in deeper into the issue of risk.
Absolutely, absolutely. So I'll come back to the issue of never borrowing for consumption, because it's one of in fact, it's the bedrock. We even call it the golden rule in debt. Like when you're building a house, you have to start with a strong foundation, because if the foundation is shaky, everything else you're going to build on there is not going to be strong. So I'll come back to the issue of not borrowing for assets, not borrowing for consumption, because it's one of the golden rules. Even under risk management, it's the foundation that we need to have. So on the issue, and that's a very fundamental question we need to know about our numbers, and especially when it comes to borrowing, because now you are introducing risk as in you have introduced an obligation to pay. So you need to know the difference between margins and cash flow, because cash flow represents the money, how the money is coming in. And how that money is coming in will determine how you are going to meet your obligations as they fall due. Whilst profitability actually gives you the indication that you have the capacity, because it means you are creating value. So it means it gives you the capacity for even stronger cash flows in the future. And the example I like to give is you have an order, right? which you sell, say for 100,000, you have a 30% profit margin. So 30% of 100,000 is 30,000. That is your margin. However, how are they going to pay you that 100,000? Are they going to pay it all at once in 90 days? Meaning, if you have something falling due at the month end, like for most of this debt, most of these obligations, they fall through on a monthly basis. You will have a receivable of 100,000. You will have made a profit of 30,000, but you will have no cash, because that cash is only going to come on the due date, which is either on the 60 days or 90 days. So you need to make sure that you understand that. Or is it a scenario where they'll pay you a deposit of maybe 20 or maybe 30% or 40%, and then pay you in stages as you go? In that case, your cash flow. So for the same 100,000 with 30,000 profit, we have different cash flow profiles. And then the cash flow profile is what is much more important when it comes to you meeting your debt obligations, because you cannot pay a loan with a promise and no, I made a profitable sale. No, it's the issue of money in the bank. It has to be money there.
Money talks.
Yeah, money talks and whatever works.
Nice one. Yeah.
So that is a very fundamental. So before you get into any loan obligation, yes, you need to understand what your profitability, which is the margin, is going to be. But more importantly, you also now need to know on a realistic basis. In fact, you even want to go on a worst case scenario. How are the cash flows going to be? So that then you can manage that. And in this also fits into our risk management, like we talked about, because that's how you manage the risk. Because missing a debt repayment is actually catastrophic for, it's not just a one event. It actually makes even your future, because it dents your reputation as a in terms of your credit history and your credibility. And already they say Zambia has a poor credit culture. It's all because of not understanding and planning very well when it comes to the issue of cash flows and when that is going to happen. Yeah.
Excellent. Well summarized. And that then now nicely leads us into the discussion for today, and that is the aspect of risk. There are different types of risks that you obviously highlight, but in simple terms, to the person borrowing, to the person lending, what is risk, and why is it important to understand the issue of risk? It is every single financial institution, when they are going to venture into these products, there is one word that they will never miss, and that is the word called risk. What is this word called risk? Why is it important to me who is borrowing? Why does it matter to the person lending? And why is it important for both parties to understand the aspect of risk? Break it down.
Absolutely, with pleasure. So risk, just by definition, just means having a result that is different from what is expected. That's a general definition of risk. So you have, and that's how life is, because life, as however hard we can plan life, it's so unpredictable, and therefore it presents risk. Meaning, we make a decision, we think this is the result that will come out, but the actual result actually comes out to be different from that. That's a general definition. But when it comes to borrowing, we can narrow it down to, first of all, what is the bank looking at when they look at a particular, to us as borrowers? What are they looking at when it comes to risk? Their risk is just in one place. It's the risk that the borrower is unable to repay. So it's either you are a low risk, meaning you have in place structures such that their money is safeguarded. Okay? Or you are a high risk, which are the two spectrums, meaning you are not in a place, like there's a very high likelihood. It's about probability. Low risk means the probability that you can default on the loan, fail to pay them, is
very low.
High risk means the probability that you're going to fail to pay is very high. So that's what we need to flip. And even for us, that's what we need to look at when we are going to get debt, in terms of saying, at this point in time, we need to understand, am I a high risk or a low risk? Because it works both ways. Because, failing to pay a loan can be something that would be the worst thing that can ever happen to an individual, because it can set you behind for years, something that you invested years in developing in terms of an asset. You can lose it just like that. And there are very solid examples. And this is public record, so it's not something that I'm not maligning. There was a company, I don't know whether it still exists, called Woodgate Investments. I don't know whether you remember it, RK. It was, I think, owned by Honorable Enoch Kavindele. So that building at Kabwe Roundabout, which is next to ZRA, that infrastructure was actually, that plot and everything else, and including the superstructure, was built by Woodgate Holdings. And obviously they borrowed and they had loans attached to that. I think by then it was Finance Bank before it was bought and whatever. They failed to pay. Immediately they failed to pay. What happened? Finance Bank repossessed, obviously, because the bank lends you on the basis of cash flow and the value of the assets you are giving. So that, if they were to repossess that asset, can they gain their money back? Yeah. And they got their money back. And, they, of course, sold it to professional insurance and so forth and so on. That's where now professional insurance is. That was not an asset that was built by professional insurance. That was a Woodgate property gone. Another example is where Radisson Blue is. I think it was called Odie's something and whatever. They are the people who owned that space and the space next.
Yes.
Again, they borrowed. They couldn't meet their obligations. The asset was repossessed, and they lost everything. So that's all to do with risk. That's why it's very, very important that before you engage into debt, because it's a scenario where you are actually committing your future net worth, you really understand risk and you go into it, knowledgeable. So risk can never be eliminated, by the way, because it's part of life, but you can manage it. And that's what we are talking about here, that it has to be managed risk and not just, unmanaged risk, because unmanaged risk is where it's effectively gambling, because now you are just betting on the upside and not thinking about what can I do in terms of the downside.
Excellent. Now, in terms of the borrower, I know we rolled out a tool, but in relation to doing a self-assessment of the possible exposure, the risks that they get into before they um, access the facilities at the bank, what sort of indicators will give the borrower that here, this is high risk, don't do it. Here is low risk, go for it. What are some of the things that a borrower would actually do to assess themselves that I think I'm trading in very dangerous waters, I shouldn't access this facility? What sort of self-assessment or tools would the borrower access to understand the possible risk areas of borrowing?
Yeah, excellent, excellent. So the first is the issue of the golden rule of borrowing, which is never borrow to buy an asset or increase your capacity to earn more than you are going to pay, and not for consumption. So you just have to ask. So the first rule is, and this is what we always even ask our clients, we ask them, why are you borrowing? Because that question, if the answer is, I'm going to borrow and then end up being in an obligation to pay, which means you have actually invested your in consumption and therefore a liability, then that is the worst risk you can take. The managed risk is where you invest in an asset that will generate income and cash flows that are, at the worst case, they should be equal to what you are going to be paying for the loan. Otherwise, it should leave you with a margin, because you need, so that margin is needed because we know that that income level is likely to fluctuate, okay, up or down. So you also want to make sure that the downside is covered. Don't just go for one level and say, look, this is my expected income from this asset, and then you go with that. Because what if that income comes down? So the first test is to say, okay, within a reasonable period that you expect, you can predict how much income and how are the cash flows going to look like from this asset. Then once you've looked at that, now you need to do a stress testing and say, oh, okay, what if the revenue came down like this? What if expenses went up like this? What is the impact on the cash flow? Will I still be able to meet the debt obligations? And there has to be a margin of safety. That's what we call a margin of safety between what you are expecting, even in your worst case scenario, to the obligations that you have on the loan. Because the obligations, immediately you sign on that dotted line, you are committed. You are committed to pay those. And if you don't pay, they will come after you with whatever you have pledged as security. Yeah. So that's really the first rule. The first rule is the golden rule. So that's why we even talked of, please, please, please don't borrow to invest in salaries, for instance, or or office rent. Maybe you can borrow to pay for a production plant rent, because you know that if you pay for the production plant rent, then you have ability to use that to generate revenue. Yeah. But office, like admin, that has to be met from your own money as part of the, your operating expenses, which you need to finance. Salaries, they need to come from there, because most of these are already consumed value. So there is no future value related to that. So that's the first rule, RK. I don't know whether you have some more comments on that, but that's the first rule. Then we can go on to the next ones.
Yeah, I think it's a very important point, that you make, because businesses, for example, I've seen businesses trying to access this one form of borrowing, which is an overdraft, to pay salaries, for example. From what you are saying, that is a time bomb, because you borrow
Time
now to
bomb.
pay salaries, the
Yes.
salaries are not going to, the service has already been consumed, and
Yes.
and it's not a service that will result into more production. The service has already been offered by the employees,
Yes.
and the next
Yes.
month again you borrow, so you see
Yes.
that the hole becomes bigger and bigger. So you'll find, if you, for example, your OD facilities 10 odd million kwacha, and the last time you finance your payroll, which is like 5 million, and then you'll find that you've consumed your entire overdraft. So that's exactly what you are saying, CD.
Yeah, exactly, exactly. And for me, that's the first test of your risk management. It has to be the purpose for which you want to go into. Yeah. So it can be a very good force for good, like we said, but if not managed, it can actually translate into a situation where you are just digging a hole, like you're saying. Um, and for me, the only hole you have is consumption, and consumption is easy. It's definitely, it's the definition is just something that has not translate into future income. If there's no future income, then it's consumption. Yeah. So, so those are the things, and why you actually need to make sure that we have that as the first, and that's why we call it the golden rule. There are so many rules on risk management, but this one is golden because
Yeah.
it's very fundamental. It talks about the reason why you're getting into debt.
Excellent. Obviously, the aspect of risk is potentially going to discourage a lot of people with good intentions to borrow. But just the fact that there is a risk, unknown risk, or you even know the risk, but you don't know how to mitigate. So people will be discouraged. The potential, the issues that you talked about, grabbed properties, failure to leave a bit of room when you know that your maximum you can borrow is X amount, but you've got this minimum, but don't go for the maximum. Try and leave yourself some kind of room so that you can have a fallback plan. To a normal borrower, is there any sort of mitigation that you can advise? I know you talked about that, dimensioning the facility at a much lower value than the actual, but any other mitigation measures that they can take before they actually venture into borrowing? What's your advice to the potential borrowers out there?
For me, I think it's to run the numbers. For me, it's to run the numbers and to be very patient. And one of the other rules is don't go into debt as an emergency response. It has to be planned, because if it's an emergency response, then you won't be able to ride it. You'll be running with emotions. I don't want to lose this order. I don't want to do this. Like for instance, you know that the worst kind of working capital financing is invoice discounting. Because invoice discounting, effectively, what you're doing is you're giving away your margins.
Your
So
margins.
it might
Yep.
work for you now, but in terms of the future, your capacity to reinvest any profits is gone purely. And most of these deals have very, very, very tight margins. So for me, it's just an issue of running the numbers without the emotion. And that's where we are there to develop tools to help so that you understand where you stand. So you make an informed decision and know that this is the risk that I'm getting. And you go in with confidence that, should even the bad thing happen, I'm able to sustain this debt. And the next rule is exactly what you said. Never borrow beyond, never borrow what you are entitled to. So the bank will come and say, okay, you are entitled to 5 million, 2 million, or whatever million. Never go to the full extent of that, but base it on numbers. And this is where now the computation as well of the income to debt ratio comes in. And for me, we even actually do it on a cash flow basis. So we look at what is your operating cash flow, free cash flow, versus the debt, so that we can see what percentage is it consuming. Because if it's consuming all of it, or it's even below, then it means you're taking in too much debt. So you need to have room in there. Because even on personal loans, like salary advances, or these people who give loans to the people on a personal level, salary-backed loans, you know that the government has a rule, and I think that one is even probably in the statutes or something, where you cannot lend someone so that their take-home pay is below 40%. I think there's a rule like that. So the same thing applies to business. You can't go and have your whole free cash flow going to debt, and then you remain with no money to run the business. Then that you are taking unnecessary risk. So your debt to income ratio. So you can see most of these, they are more about thinking before you go into debt. Don't just go into it. You need to sit and plan, and so that it becomes part of your execution strategy, rather than it just being a by the way, something that feeds into something. Because otherwise you end up, absorbing unnecessary risk, which would finally make you lose everything you have worked for. Everything. People actually, even mortgage their homes, the home that they live in, as part of the security. So I think, therefore, it calls for some deliberate preparation. So I think it all comes back to preparedness, and thinking about this, so that then you go in at the right level of debt, which is sustainable. Because again, you have to look at, can I manage this debt in a worst case scenario, even from my current income? Say the asset I'm building in, for some reason, has got a delay in generating cash flows. Can I actually manage that? And this is where the issue of building reserves is where, we always talk about the 13-week cash flow forecasting as a tool to help you create that those reserves. And you need to have minimum 3 months. If you don't have them now and you want to have debt, you need to have a plan of how you can start building them up. You can build up 1 month, build up 2 months, and this is by reinvesting profits in those cash flows, so that you prioritize building up reserves, so that you are ahead of the repayments. So you can say, oh, okay, by emergency fund is now at 3 months, is now at, best case is actually 6 months. So for me, once you start having those disciplines in place, then you manage the risk with debt.
Excellent. One of the tools you did mention about, careful planning, and you've talked about this a number of times, and it's having your projections neat and tidy. I've seen a number of times, quite often, businesses do some kind of thumbs up approach. When you're doing your projections, for example, you're doing your 2-year projections, you may have your first 2, 3 months because that's close to reality, maybe very close to accurate. Then thereafter, the bad habits kick in. You now start saying, my business will grow by 5%, some guesstimates, nothing scientific. And as a result, my cost of sales will also increase by 5%. My expenses will follow a certain trend. And then that eventually may show a very good picture of your ability to repay the loan. But what that does, which is basically, tying in with the issue of risk, is it does not help a business having a closer view on the risk. What's the importance of you having, I know we've talked about it, but just to shed a bit more light on having properly crafted projections to support your case to repay a facility.
Very important too in terms of risk management. Very important, because all those things I've talked about, the issue of the margin of safety, the debt to income ratio, all those numbers really come from what you have talked about, and I'm glad you brought it up. So it's very important that you generate reliable cash flows, realistic projections, which would be, covering the whole business, and even including what the impact of debt is. And then on top of that, don't just do a forecast based on one assumption. We now need to stress test it, where we say, okay, in a worst case scenario, if this doesn't happen, yeah? So scenario analysis is very, very important, especially the downside. The downside, you want to say, okay, if this happened, how can we, if the revenue went down by 20%, or we didn't achieve the revenue by 20%, the costs went up by this much and this much, what would be the impact? Then you now start looking at what's the impact on those key ratios. The debt to your operating cash flows to debt repayments, your EBITDA. EBITDA is very important. So EBITDA is earnings before interest, taxes, depreciation, and amortization. So why we go for that is it's a very good proxy of showing whether you have the ability to pay the interest. So in the next episode, probably RK would be an issue of knowing what amortization means, because the bank, and we'll get into much more detail with a proper example. The way the bank structure these loans is that because their income is the interest, so they want to get that upfront. So you find that whenever you are paying, whatever you are paying, your initial payments, most of them actually go towards interest and not capital. Yeah. So the EBITDA gives the bank and gives you an indication of how much leeway do you have in terms of how much interest can you absorb. Yeah. So the depreciation and amortization, because we know that those are non-cash items, and then the interest is what we are looking at. The tax is always after the interest. So that's why we have it like that. That's why. So we have those, and maybe in another one we'll need to go through what do these measures actually mean to the bank, and therefore what do they mean to you, so that you can understand them. And once you understand them, then you're able to plan properly, so that even your because that's what the cash flow should be able to say. Should be able to say, are we able to afford the level of interest to be paid on the debt we are going for? Then you have the debt to your operating free cash flow, operating cash flow to debt repayment ratio gives you an idea. So when you do your scenario, you start seeing, do we have the margin here, or we are going underwater, as they call it? then that would help in managing and say, okay, so maybe we are going too much, we're exposing ourselves too much. We just need to have the right amount. Because in terms of debt, if you go beyond what you can afford, then you are effectively gambling. Because now you are gambling on the upside, and we all know how life is. It will, it
Excellent.
always doesn't work out the way we thought it would.
Excellent. As we get to the parting greens, CD, word of advice. It's always a challenge for people to think everything that we have said is actually practical. But maybe a word of advice to the business out there that whatever we're discussing, if you've got a challenge, you can actually come to us and we can help you put all these things together. We can help the business, structure a facility. We can help a business put up all the projections and identify certain risks associated with the borrowing, put mitigation measures, and make sure that we monitor those risks in the within the duration of the facility. Just highlight what we're able to do as a business, as Moore Zambia CFS.
Yeah, no, excellent. So we now have a dedicated team under our fractional CFO where we have developed tools, and we've looked at two markets or two groups, segments that we really want to focus on. One is the growing businesses, and mainly there we want to see that we can help with working capital trap. So in there, and these are pretty much small ticket size and things like that. And our focus there is just to ensure that we can package you, we can help package you, and so that you can even make commitments such that the risk assessment by the bank is much easier. And we even have very strong relationships with a number of financing institutions who have shared with us their own internal criteria. So we use that to help you. And sometimes people think, no, this is going to cost a lot. No, what we've done is develop tools to help us and leverage technology to actually do quite a lot of this, including the free app that we have shared. But we have a much more comprehensive stack within that we are running with, so that at a very affordable rate, we can help you to prepare so that you have full clarity. You go into a place, you are going into debt. It won't just help with the turnaround, it won't help with the quick decisions, but it will also help with your clarity and what you need to do to manage the risk. And then we've got the one on project finance, which is now, this one is a much longer term. Again, we've hooked up with partners, and in fact, even right here where I am, this is the reason we're here so that we can speak to partners that are willing to come and invest in viable projects in Zambia. So that aspect as well. So we are there in the bankability, as a bankability preparation partner, so that we can do project bankability preparation. It goes into the process, it goes a very high chance of being financed in the shortest possible time. So that's why we're there, and and we want to make sure that everybody else really has it. There's never been a better time, in my view, right now. In the next 5 years, there's never been a better time to grow. Because one, we've got SI 68, which has come through. Now, the trickle-on effects that come from that is what excites me. You know, we're talking about 3 million tons by 2030, 2031. What does that entail in terms of production of goods and services? You know, the infrastructure. So our manufacturing base. This is the time to now bring a manufacturing base in Zambia. And to do all these projects, most of it, actually, the biggest available funding out there is debt. So we need to know how to manage debt so that it doesn't rob us of our futures, but we use it to execute the opportunity.
Excellent. Excellent, CD, and great stuff. Always amazing to chat with you. And like you said, we have a couple of issues, a couple of topics to cover. You talked about project financing, relating to a number of projects, and we'll be discussing that in the subsequent podcasts. We talked about certain manufacturing processes. It could be agriculture, it could be meat processing, different projects, and we have very established things that can pour resources into the Zambian economy to help business raise money in different aspects. And we'll be discussing that in our subsequent podcast. But as usual, CD, you've been amazing. Excellent stuff.
Yeah, same to you. It's always a pleasure, man.
Always a pleasure. Enjoy,
Yeah.
and I'll be back again next week. Thank you,
All
CD.
right. Over and out.
Cheers. Thank you.
Cheers.
Cheers. Bye. Thank you.